So as mentioned last week, we're covering the loan account classes for 3 weeks, this being week 2 of the series. When I say last week, I mean 2 weeks ago, but anyway. So today we're going to go through revolving credit loans and their associated features. Each loan class has their own module and each have their own features, benefits, and in some cases limitations to be aware of to make sure the client's needs are fully taken into account when choosing licensing options and when assisting them with the initial and ongoing configurations. Last time we went over the global settings briefly, over scripting, events and options and where to configure them, and over some of the areas within the account types admin library, and of course the fact that fixed term loan accounts fix their rate for the entire term of the loan and require a restructure to amend the interest rate, etc. Today we're going to go through in more detail some of the account type settings with a particular focus on those related to revolving credit accounts only, as they're quite different. We'll start off with a brief overview of the features available that make the revolving credit account unique and arguably the most flexible of the loan classes. And then we'll have a look at some examples and other settings. So the maturity date and term. Revolving credit accounts are the obvious choice for lending products that require the flexibility to redraw funds, like with a store card or line of credit facility, have multiple drawdowns and or true interest-only repayments, like perhaps for a development or construction loan, and facilitate things like line or utilisation fees and interest, multiple credit limits and more. Revolving credit accounts, unlike the other two loan classes, do not have a fixed or hard set maturity date. And whilst you can choose to define one, this class does treat that date differently, which is something to be aware of. Not having a maturity date or term is ideal for lending products that by design keep going or do not technically end until either party chooses to terminate. Where a maturity date is set, the repayments will be calculated with a view to repay the debt by that date. However, unlike the other two loan classes, a revolving credit account will not close automatically past maturity, even with a zero balance. It will still, however, appear on an exception report and show warnings on the account. Like here, this one is past maturity by 37 days. And this is the exception list report that shows a warning. Moving on to minimum payments. This is a big area that is very different for this loan class and other payment options. Because revolving credit accounts do not have fixed balances or hard set repayment terms, payments to revolving credit accounts are calculated differently using a minimum payment basis. This is defaulted from the account type, but it's also possible to select a different basis for each account where required. As revolving credit accounts do not have the option of restructures, this is one way in FinPower Connect that you can adjust the client's payment amounts and the method for calculation of the required repayments. These different basis options are possible in part due to the fact that there isn't that hard set maturity date that we just spoke about, which will become more apparent as to why as we go through them. There are currently 11 different minimum payment basis options available, as seen here. These are set value, which gives the ability to define a specific set payment value, for example, $200 a month, that will continue until the loan balance has been repaid. Ongoing set value, which is similar to the last, but gives the ability to define a specific payment value which will continue even when the account has a nil balance. Percent of balance, which is a payment that will be a set percentage of the balance, for example, like 3%, which is a fairly standard minimum payment across the industry for things like credit card products. Higher, which this basis will take the higher of the two set values. So you can set a minimum payment value, for example, $25 a week, and a percentage of the balance, and the payment will be the higher of the two options. This is more commonly used for things like store cards. Installment, This is the option that's used in conjunction with a term or maturity date and will calculate payments required to repay the account by this date. However, this is not exactly the same as a fixed term instalment option, as the instalment amounts will vary from month to month and may not calculate perfectly with a set date, which is something to be aware of. Interest only, which is only the accrued interest for the frequency period, will be requested as the payment due. This is good for any situation where immediate principal reduction is not required. A common comparison for interest-only repayment use would be a credit card, usually with no maturity or term, or a construction loan, typically has a term but no principal reduction initially, and a condition set for the interest-only period length. Interest and fees only. This payment will include the interest charged for that period and any fees charged within that period and does not include standard transactions. The interest balance. This option will, as indicated in the name, take the balance of the interest as at the date of the statement generation. And a special note on this option, it should not be used without customizations where the due days are set to 0 and the interest charge date is the same day as the statement. Same with the next option, interest fees balance. This includes the fee balance as well as the interest balance as at the date of the statement generation and shouldn't be used where the due days are set to 0 and the interest charge date is the same day as the statement. The none option is for situations where either no repayments are required until a set date or to cover other various scenarios. And finally, custom, which can be selected if a scripted option is required to customize even further. These items are set on the payments page on the account type setting, as you can see over here to the right. And the basis must also be set in conjunction with the due days, which I briefly mentioned with the different bases here. And the due day settings is, as you would expect, the number of days after the statement is issued that the minimum payment is technically due. As briefly touched on before, revolving credit payments are dependent on the generation of the loan statement, and as a result, so is the payment frequency. The statements are created by running the account processes, which in turn then generates the minimum payment on the loan. It also creates an instalment due transaction for the future date, which will be set based on what has been selected in the due day setting. This is how the statement cycle therefore defines the payment frequency. Depending on your client's requirements, it may be appropriate to set the due days to 0, but not with those other two bases that we mentioned. This combined with the minimum payment basis make up the overall structure of the client's agreed repayments, meaning where a borrower is wanting to change the value and frequency of their repayments, as an example, changing from weekly to monthly, both the statement cycle and the minimum payment settings on the borrower's account will need to be changed. The minimum payment change wizard allows you to change the way the minimum payments are calculated in the future for the selected loan and can be accessed by clicking the review button. Nope, that's not where we want to go. Here, sorry. Here. And the minimum payments block on the account is shown via the payments page or via the review button on the financial page. The financial page also has the buttons available to view the schedule, amend the statement frequency and more, so it's probably the easiest location to review the account as a whole. Once you've clicked the review button, to open the minimum payment change wizard, you simply click on the revise minimum payment button, which is displayed with the pencil icon here. And it's easy to follow through the wizard and change your basis if necessary, change the value, the percentage, etc. There's also the option to tick pay full current balance when due by direct debit. Like we said last week, the easiest way to discover what an account type setting or option does is simply to test it out. The same thing applies for seeing the difference in the payment basis. It remains one of the easiest ways to see and work out for yourself how it works by reviewing things like the summaries on the financial page, running the account processes, and reviewing the transactions created, and reviewing the generated statements from the logs page, to name a few. Again, for comparison, making two new accounts in your test environment, the first with your original account settings, using the same dollar value and interest rate, etc. for both, and changing the payment basis for the second account is a relatively quick way to see the difference between your original payment basis and new by comparing things like the end date, repayment amounts, and looking at the schedule as well. The schedule, just as a side note, will show you on a revolving credit loan the next 2 years worth of projected transactions. Payment arrangements. Setting payment arrangements on a revolving credit loan does not create extra payments that are due, as they're still driven by statements. Therefore, it's important to keep in mind that if a different frequency is required, or you need it to be tracked in terms of the account becoming overdue if a payment is missed, and so on and so forth, then the minimum payment and statement cycle will require updating. The payment arrangement wizard also allows the use of an alternate schedule, which is another feature unique to revolving credit loans. The alternate schedule can be used where the borrower might want to increase their repayments for the foreseeable future or change to a fixed value, but you do not want to alter the underlying payment basis of the account, or as another way to utilize a change in payment frequency. The alternate schedule does not alter the statement frequency, which is something to keep in mind in terms of how the statement will appear to the client and what will be shown in the overdue section and the total due now, like this example here. Over here on the right is a normal schedule statement, and over here is an alternate schedule statement generated. The basis is monthly and the alternate is fortnightly. Rate tables. Rate tables are used to pre-program interest rate changes when opening a new revolving credit account or when changing the interest rate of an existing revolving credit account. To choose which rate tables are available to your revolving credit loan, this is set on the account type as shown here. And to amend the rate table itself, it has its own admin library. Rate tables are also available for fixed term floating rate accounts, but as mentioned last week, are not available to fixed term loans. A rate table can program rate changes spread over a period of time, for example, 6 months at 0%, followed by 12.5% for the remainder of the first year, and then 15% for the rest of the life of the loan. Or interest rates can vary according to the balance of the account by using a tiered rate. For example, 10% up to $10,000, 15% up to $20,000, and so on. On a rate table, you could include a combination of both with tiered rates for different periods in the loan's life. There are many options available. This is particularly useful if you're trying to replicate a typical home loan functionality, like moving automatically from a fixed rate onto a floating or updating a base rate. Revolving credit loans also still have fixed, variable, and interest-free options with the full complement of interest calculation methods as well, which again, as we showed last time, are available on the account type settings via the interest page and the interest options page. Now on to some commonly asked questions. One of the biggest questions that comes through the support inbox is, how can I change the statement frequency but keep the payments weekly on a revolving credit loan? And the answer is, out of the box, you can't, not really, but we had several clients using custom scripts to set the statements generated for the payments to not issued, and then have a custom statement running at a different frequency. For example, it's unlikely that a borrower is ever going to want to receive weekly, fortnightly, or even monthly statements in some cases, though they might wish to make their repayments on a weekly basis. In that scenario, depending on your client's business requirements for their lending product and purpose, and in terms of statement frequency minimums, which is usually set by the CCCFA or NCCPA regulations. They may prefer to go for a customization and send something like 6 monthly statements. Within the UI, there are some out-of-the-box ways to set the statements to not issued on a bulk basis by using the Publish Documents wizard. There's a little icon below the grid down here. Not sure how well you can see this, but there's an option to select all, include them with the tick box, and then set them to all to not issued. So it doesn't always require a script if your client isn't wanting to go that way. However, a custom document would still be required to send a statement. Then you simply save the grid and they will disappear out of the Publish Documents wizard. You can also obviously use the standard from Power Connect filters to filter your list down to just the statements you actually want to set to not issued as well. Another commonly asked question is, why can't I see a restructure button? As we've already covered, there's no concept of a restructure for revolving credit loans, so each aspect that requires changing will need to be adjusted accordingly. This may mean that a custom document is required to cater for disclosure requirements in some cases. Finally, as mentioned last week, it's important to note that it is the responsibility of the client to check the configurations are correct and fit for purpose, including any customizations if necessary for both their individual business purposes and legislative requirements. Another one we get asked is, how do I reverse a statement, which is available here under the statements block on revolving credit loans, and you simply click reverse last. We've come to the end of our session for today, but as always, if there's any additional information you seek, don't hesitate to contact application support for user interface queries or code support in relation to code-specific questions, as there are many scripting events available throughout many processes involved with accounts that can be utilised for custom requirements. In our next session, we'll be covering the final loan class, fixed term floating rate loans.